So we're going to work on Singer and Audience here. They have identical accounts receivable experience, but they're using two different methods to estimate their bad debts. So Singer is going to be using the sales method, or percentage of sales method, and Audience is going to be using the receivables method. So let's start. They both have sales of $700,000, of which only $600,000 are on credit. The rest is in cash. So we don't have to estimate any bad debts for non-credit sales because they've already been collected. So at year end, they hadn't collected $100,000, so that's the ending balance in accounts receivable. And they've written off $9,900 during the year. And the beginning balance in the allowance, so left over from last year, was the $13,000. So let's set that up. So here I've typed that out for you. You didn't have to watch me type. So we have the allowance for uncollectible accounts for both of your clients. They both start with the beginning balance, which is the same for both of them. We can put that in here. The beginning balance was $13,000. We don't know the bad debt expense for either one of them right now, but they both wrote off $9,900. We can put that in here. Okay, so let's do the first one, Singer sales method. So under the sales method, you will calculate the bad debts, and then the ending balance in the allowance account is just whatever the math ends up being. So let's calculate it. So this bad debt expense will be the credit sales, so $600,000, times the percent that they have determined as their long-term experience. Here it is 1.3% of sales. And of course, when you're doing the multiplication, you move the decimal place 2 places, so that'll be 600,000 times 0.013. So we get 7,800. So then the ending balance for Singer would be the 13,000 plus the 7,008 minus the 9,900. So on their balance sheet, they will report that 10,009 as a reduction to accounts receivable, and I'll make you a little visual in a minute. Let's move to your other client. The other client is using another method. The receivables method calculates the target ending. What do I need to have in that allowance account to be enough to cover what has not been collected yet? And then when I know what I want the ending to be, then I will make the bad debt expense whatever amount I need to get to my target ending. So let's calculate the target ending. It needs to be 8.5% of unpaid invoices. So the unpaid invoices was $100,000. And remember to move your decimal place over 2. So 8.5% would be 0.085. So the target ending would be 8,500. So the question is, what number do I have to put in here so that when I add 13,000 plus that number minus 9,900, I get 8,500. So in order to solve for X here, the bad debt expense, it's a little bit of algebra. So 13,000 plus X minus the 9,900 will give you 8,500. So then you have to solve for X. So you have to subtract 13,000 from both sides and add the 9,900 to both sides in order to get the math. Once you've gotten a calculation, of course, you can check it. So you can put the number in here that you calculated, and then you can add. You can add these two and subtract the third one and see, do you in fact get the target of 8,500? And if you don't, you know you've done something wrong, and you can go back and fix your math. Okay, so the adjustments that need to be made is that bad debt expense, a debit to bad debt expense for the 7,800 and a credit to the allowance account for 7,800 for Singer. And for Audience, we need a debit to bad debt expense of 5,400 and a credit to the allowance for 5,400. And then they ask which will lead to higher net income and which will lead to a bigger balance sheet and why. So let's make a little income statement, a little balance sheet presentation here, and get a visual. Alright, so I've set up a little skeleton here for the balance sheet and also for the income statement. So both of them had $100,000 in uncollected accounts at the end of the year. So they would both have $100,000 in accounts receivable that would be reported on their balance sheet. And then as a reduction or a contra account to the accounts receivable, we would have their ending balance in the allowance account. So the ending balance for Singer was the $10,900, and the ending balance for Audience was the $8,500. So the net realizable value for Singer is the net of those two. So they are going to report that they think they're going to realize cash of the $89,100, even though they hope to collect, and they will try to collect the whole $100,000. But their estimate is that some of those customers will not be able to pay. Audience is going to have a net realizable value of $91,500, so it's going to have a larger balance sheet amount for accounts receivable because they have a smaller allowance for uncollectible accounts. Now, the impact on the income statement. The bad debt expense for Singer was the $7,800. The bad debt expense for Audience was the $5,400. So which one's going to give you higher net income? The one with the lower expense. Because when expenses are lower, then profits are higher. So I've written out here a potential response to the third question, which is, are they both correct? Both methods are acceptable methods, so they are both correct computations of each of the two methods, even though they don't match exactly. They will be similar over time, as the rates, those percents that the clients gave you, have to be adjusted periodically based on the actual experience. And the actual experience in this case was the 9,900 write-offs. So if it turns out that year after year that percent doesn't get close to the 9,900, they'll have to adjust those percent. That is the end of this exercise.